Carl, good morning. As we talk about the idea that setups are starting to happen as Wall Street gets back into full swing coming off vacations, we do see that we have a S&P 500 that's currently hovering just around 2909 or thereabouts. So still making a move towards that 3,000 level and then holding kind of steady right at 2908, as you can see here. So as we watch what's happening with markets, a down day across the board. But what's interesting about the setups right now, take a look at some of the ways that the cap structure is worked out with regard to small, medium, large cap stocks. If you look at the S&P 500, Russell, and the mid-cap 400, that's the way it is. The Russell 2000 is still up about 10% right now on a year-to-date basis, 12% for mid-caps, and then 16% for large caps. So that gap between small and large continues to get a little bit bigger right now. That's something traders are watching. Also, the development between growth and value. So far this year, there has been a market outperformance in certain parts of the market, specifically with regard to growth stocks over value stocks. One thing that you can see here is the Russell 1000 ETF, the one that tracks it, the IWB, is up about 16%. Meanwhile, the value side of things is up about 11% and almost double that in terms of the growth side of things. So growth continues to be the driver of that environment for stocks overall. We'll see if that trend continues. You can see that kind of gap getting bigger there. Also, with regard to the sector performance over the course of the near to medium term, if you take a look at the real outperformance and underperformance in the summer months since about the end of May, a massive move for technology, up about 12%. Meanwhile, financials and energy, the two worst performers. So you can see that technology, communication services trade still really driving a lot of the action here. That'll be one thing to figure out as the volatile summer kind of comes to a close heading to the year end. And then just to kind of put a bit of a macro spin on it, remember, so far this year, stocks, bonds, and gold have generally performed all within the same relative area. But over the course of the past 3 months, that's where the real outperformance has come out. Stocks in the S&P 500 are only up about 6% over that 3-month span. Meanwhile, long-term Treasury ETFs are double that performance and triple that coming from gold itself. So as traders get back toward the second half of the year and going into the last maybe holiday season part of trading, that setup is going to be something that's going to be real key. Does it break down? Does it return to historical norms? Or do gold and haven assets like bonds continue to outperform stocks? All some of the big themes that traders will be dealing with, Carl, as things get back into the last 4 months of the trading year. Certainly something we'll be watching today, guys.